Hello, everyone. I hope you're doing well. Welcome back to Canadian Finance Truths, where we really discuss all kinds of topics, primarily relating to out of the box financial concepts such as the infinite banking concept and velocity banking. Apologies, since it's been a while since my last video. My whole family came down with COVID, and so we were quite sick, but it wasn't too bad. Anyway, what I wanted to do today is get away from discussing a particular topic or answering a particular question. I received a comment from Vinny Ray on my "Should you finance everything through IBC" video, and he had some interesting points to talk about, and I wanted to discuss those today. So we're just going to kind of rhyme through this. And so, reading this out loud, and I'm sure you can see it on the screen, Vinny says, "My take is to, as comfortably as possible with reserves, pursue 100% leverage on cash flowing assets." Now, when we look at cash flowing assets, you're typically going to be talking about real estate, potentially businesses, although that does get a little tricky, and then the stock market, probably dividend paying stocks, right? And the only way to obtain 100% or near 100% is indeed going to be with the IBC, and he does cover that in the future, but it's going to be with a whole life insurance policy. So we already know that, which I couldn't agree with more. But what I actually want to comment on here is comfortable with reserves. So one thing I don't believe I've discussed in videos, but essentially, when you go and purchase out a policy, one thing you have to realize is that there is a cost to the policy. And when I say a cost in this instance here, I'm talking about uh, n- um, the pure dollars and cents required to then put towards this policy. So, if, for example, let's pretend we're talking net numbers here. If you make $100,000 and it costs you, I don't know, making up numbers here, $80,000 to live, and you want to fund a policy with $20,000, well, the issue with this is if you do this in this process here, is that let's pretend, 5 years down the road, you've got yourself $100,000+ in your IBC policy, depending on how it's structured. Then what would end up occurring if you go and borrow $100,000, you now have to choose if you're only making the $100,000 between uh, funding the policy or paying back the loan that you just took back. Um, so I think this reserves is critical. And then also the fact that he's saying put it towards cash flowing assets, which means that the yield that you get on this $100,000 investments can be used to pay this back. So you've got this double whammy effect. So you may be neutral here, but sometimes you're not. Some investments take time to go through. You think of, say, for example, a land development, right? You want to go and purchase land to then build a commercial building on. I'm just making things up here, but it could be real. And you may not have an immediate cash flow that's generated from this. You may have to wait a year, 2 years, 3 years before you start generating a return. And you have to decide at that point in time whether you continue to fund the policy or whether you pay back the loan or a combination thereof. And this isn't an easy decision to make, although just for simplicity's sake, typically it makes more sense to pay down the loan than it does to fund the policy. Anyway, so we continue, and I'll erase all this here. But I hope that makes sense, right? That is an issue. So I do agree. So if you want to be conservative when setting up your policy, and everyone says, no, I want to be as aggressive as possible, be aggressive with the policy itself. Don't be aggressive with the creation of the policy, if that makes sense. So let's say, again, if you make $100,000 a year, and your expenses are 80, let's keep things consistent. Maybe you only fund a $15,000 a year policy. You keep $5,000 in reserve, and then you can go about this and have a healthy cash savings relative to your IBC, of course, and then you're still living your life, and then you work on increasing this top line, and then you can always go and fund new policies in the future if that's what you choose to do. So I hope that makes sense there. I wrote. Oh, there we go. Okay, so then he says taking out an 80% mortgage on an investment property will have somewhere between a 4 to 5 times return on your 20% down payment. I'm not exactly sure, Vinny, how you're getting the 4 to 5%. If you're talking annually, that might be tough. Or if you're just talking over the lifetime, which certainly I would argue you could potentially make more. But you're indeed correct that the bank doesn't participate in the appreciation of the property. And while they do appreciate in the pay down of the property, they're certainly not uh, benefiting, at least except for the interest that you're paying and the money getting back. They're not benefiting from your paying down that asset as well. And he further goes on to say, but if you use insurance company money to leverage the down payment and closing costs while your money is compounding uninterrupted, you've achieved infinite return since theoretically none of your money is in the investment. You're indeed correct. I'll tell you what, one of my, if I'm going to talk as a layman infinite banking participant, I don't want to say practitioner, although I do practice the process of infinite banking. I don't like this idea of this infinite return. And simply the reason why is because yes, your money's in the insurance policy, and yes, it continues to compound. But if you were to withdraw, that loan gets paid off, and so yes, theoretically, your money's not in the deal. But I mean, if you were to pull it out, you do lose. Your money pays off that loan, which in theory, in practice, rather, your money is indeed in the process. However, you are right. Your money does continue to compound uninterrupted. So on your real estate investment, that's say earning on an annual basis, I don't know, say 20%, let's say, your money that's in your policy is generating anywhere from say a 3 to 4%. Let's say you're getting some really, really good growth on your money here. And yes, indeed, if you do leverage this, then theoretically none of your money, so your cash on cash, is infinite, I guess, right? But I mean, we can talk about this in practice, but the money that's actually flowing, right? Um, so the idea is you take the net cash flow from the properties to eliminate the down policy loans, which frees up liquidity, and then you rinse and repeat. And so the idea here is you go take a $10,000 loan and for closing costs and down payment. I mean, that's low, but again, for argument's sake, and then you generate a property that say generates I don't know, let's say a $200 net cash flow per month. So you're talking $2,400 a year. You then use this to pay down the policy loan. And then eventually you're going to have another property that you're going to be able to go to that now has $2,400 as well a year. And now you're paying off the combined total of $4,800 a year, which now you can accelerate this over and over and over and over again. Obviously, simplistic example, but an example nonetheless. And the really good part about this is because you can leverage up to such a high degree on cash flow property, sometimes people will buy an investment property, an owner-occupied duplex, let's say, for example, they'll put 5% down, then realize quickly that they need to have repairs, but they don't have enough equity in their property, at least in Canada, to refinance their property. Whereas if they use their IBC as they pay everything down, they can access that cash back almost instantaneously. So it is a good hedge for real estate. Actually, let's be fair, infinite banking is the perfect pairing to real estate. So that's good. Infinite banking policies have been brilliant. Yep, couldn't agree more. Eventually, when combined net cash flow exceeds all expenses, and once we could conceive refi portfolio periodically to strip as much property equity as possible. And this is a really good one. Best creditor protection and inflation hedge is a high portfolio debt. So absolutely, creditor protection. This is huge. A lot of people do not think about this. They think about having a low loan to value for lending purposes, but the reality is if something were to ever occur, there's a lot of risk in having a lot of equity. So I can cover that in another video, but that is indeed true. My only thing I would say is that you may run into some difficulties, and a lot of people have failed due to leverage. And so while a lot of people would say, okay, let's strip equity away from the portfolio, the real estate portfolio, to then just invest right back into the real estate portfolio, perhaps consider alternative investments that they're a little bit more safe. maybe at this point, and people are gonna like crucify me for saying this, I'm just thinking out loud, right? There's many options. You could look into like a seg fund that has some guarantees as well, and allows you to participate in market gains. Although I know I've talked about this, the stock market returns are not as brilliant as you would otherwise think, but what they do allow is liquidity. They are very, 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 very liquid to a degree that that real estate could not be and will never be, and certainly a little more liquid than infinite banking just because of how they operate, but not by a large degree. But if you have no other options, maybe it's a good one, especially if you like guarantees that the IBC allows. Anyway, let me know your thoughts. Again, I don't claim to be an expert on any of this stuff. I'm just a dude that really likes infinite banking, and I would like to hear your thoughts on what you think about Vinny's comments here. Let me know in the comments below. And, got to give Vinny props. I think this was a well thought out answer. And I think this is a great way to build wealth. And in fact, is a process that I'm currently undergoing, in the sense of using infinite banking for the purposes of real estate to then build up a portfolio. Anyway, I hope that makes sense. If you have any questions, comments, ideas for future videos, let me know, and please like and subscribe to the channel. Have yourself a good one.